So welcome to the fifth episode of strategy analysis, and in this video I'll be talking about market structure. So market structure is all about the market making higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend. So this is your higher high, the market goes up making higher high, goes down, higher low, goes up again, higher high, goes down, higher low, then goes up, higher high, and now this is where we are expecting a higher low before we can enter the market. And this is the 4-hour time frame or 1 hour time frame. So this is the bigger time frame. When we're in an uptrend in the bigger time frame, this means all we should be thinking is buy. We want to enter a long position. We want to buy the market. So these break of structure are like confirmation that the markets are really going up. So higher high, higher low, and then the market broke this recent high to the upside, making a new higher high, and then comes down, higher low, then goes up again, broke this higher high, giving us a break of structure, and then goes higher to give us a new higher high. So these are your break of structure. These are your break of structure. They are like confirmation that the markets are really going up because the market keep breaking the highs to the upside. So this is an uptrend because the market is going up. And when the market is going up, what do? We buy. Do you understand? When the market is going up, we buy. All we should be thinking is buy. So at this point, what do we wait for? We wait for the market to come down, giving us a higher low. So when the market is at this point, around this area, what do we do? This is where we go over to the smaller time frame. Take a look at this. So the market can be in an uptrend in the bigger time frame, but if you go over to the smaller time frame, you might see a downtrend. Why? This will tell you that this point of going down, this downtrend here, if you go over to the smaller time frame, this is what you see. Lower highs, lower low, lower highs, lower low to the downside. So this is the smaller time frame, which is the 15 minutes or 5 minutes. So now we're in the smaller time frame. We've seen that the market is still going down. This is where we wait for a market shift. Now this is your market shift. The market broke above the recent higher low. The market has been making lower high, lower low to the downside, which is this downward movement to the downside. And then all of a sudden we see a market shift. And when we see a market shift in the smaller time frame, this is where we say, okay, this trend is about to change. The market is about to start going up now. So the bigger time frame would tell you this. The bigger time frame would just show you just a little movement to the upside. So you have to go to the smaller time frame for your confirmation. The smaller time frame will give you confirmation that the market is about to change direction. So when we see a market shift in the smaller time frame, and then this will enter for a long position. Stop loss below the recent lower low and take profit to the next swing high. This is your swing high. Now you've entered your long position. Why are we buying this market but we're in a downtrend? Why are we buying this market? This is because we're following the bigger time frame. This is the bigger time frame. So there's a saying in the forex industry that says the trend is your friend. So we are following the trend. Where is the trend heading to? The trend is headed to the upside. So we're in an uptrend. We ought to buy, no matter what the smaller time frame is saying. As long as we're following the picture of the bigger time frame, then we're good to go. So right now we just entered a long position, that's buy. So, and I'll take profit to the next swing high. This is your swing high, that's here. This is your swing high. So you can also see your position in the bigger time frame too. You entered a long position and then take profit to the upside. So this is where we wait for the market to go up. If you take a look at this market from the bigger time frame, you see that the market is in an uptrend because the market is making higher high, higher low, higher high, higher low, and this also is your higher high, and this is your higher low. So what do we expect from this point? We're expecting the market to go straight to our take profit to make a new higher high here. This is also this, so the market goes up straight to our take profit. So if you don't understand, I'll explain one more time. So the market is in an uptrend. How do we know the market is in an uptrend? Because the market is making higher highs, higher low, higher high, higher low, higher high, higher low. So this is where we went over to the smaller time frame, which is here to find a market shift. And when we saw the market shift, we waited for retracement, and this is where we entered for long position, and market went higher straight to our take profit, creating a new higher high. So the very thing you should know is that when the market is going up, when the market is in an uptrend, so we wait for the smaller time frame to finish its retracement, and when we see a market shift, this means the market is about to change direction. So this is where we entered a long position. So this downward movement is this place. So in the bigger time frame is just straight to the downside. If you go to the smaller time frame, you see every detail about the downtrend. Lower highs, lower low, lower highs, lower low to the downside. So when we saw a market shift, this is where we entered a long position and take profit to the next swing high, which is also here. And the market went straight to our take profit. Why? Because we followed the trend. So now you see why the trend is very important. If you don't follow the trend, this is where you might lose trade. So this is for the uptrend. Now let's go over to explain the downtrend. So the downtrend is simply the opposite of the uptrend. This is the bigger time frame. The markets are making lower highs and lower lows, as you can see. Lower high, lower low, lower high, lower low, lower high, lower low. So these break of structure are confirmation that the markets are really going down. So we have a break of structure here, we have a break of structure here. This means the market is going down. So now the market is going down. We know that we should enter a sell position. We should sell this market. We should short the market. So where should we enter our short position? Are we entering our short position from here? No, we can't enter our short position from here. Because if you enter a short position from here, yes, you're right, the market is going down, you should sell. But this is like you're selling too early. We have to wait for retracement to the upside, go over to the smaller time frame, wait for market shift before you can enter a short position. So these confirmation are what you should take, because if you don't take them, your chance of losing is 99%. Just like this trade. Take a look at this trade. The market goes down, lower high, lower low, you know it's a downtrend, and when the market is here, now you sold from this point, from this very point. And look at what happened. Market went straight to your stop loss, took you out, and then now the market is going down your way. You don't want to be this guy who got taken out before the market goes this way. No. So this is why we should wait for the market to give us a retracement before we can enter the market. Let's take this out for now. We're in a downtrend. What do we expect to do? Yes, we know we're supposed to sell. So we should wait for retracement to the upside. Now, when you see this retracement to the upside, this is where you go over to the smaller time frame right here. This is where you go over to the smaller time frame, which is the 15 minutes or 5 minutes. So when you go over to the smaller time frame, this is what you see. Higher high, higher low, higher high, higher low. So if you go over to the smaller time frame, this is what you see. The market is going up, which means the market is in an uptrend. Yes, you can see that very clearly. So you might be confused. The market is in a downtrend in the bigger time frame, and why is the market going up in the smaller time frame? This is because this is not an uptrend. This is a retracement to the upside. It's like the market is taking in some air before it could breathe out massively, because the market is really going down. So at the end of the day, the market is going to go down, and if you see any uptrend, it's just a temporary retracement. Now, what do we do from this point? This is where we wait for our market shift, and this is our market shift. The market gave us a market shift. Now, this is evidence enough that the market is about to go down. So we can wait for a little retracement again, and then this is where we enter for a short position. So you might be asking, why are we entering a short position? We are in an uptrend, and I will remind you again, this is the 15 minutes time frame. We do only what the bigger time frame tells us to do. The bigger time frame is going down, we should sell. So going over to the smaller time frame, we shouldn't listen to the smaller time frame. The only thing we should be looking out for in the smaller time frame is a confirmation. And what is this confirmation? This confirmation is this right here, the market shift. This market shift is telling us that, okay, I'm about to go down. This market is about to go down. This market is about to do what the bigger time frame is doing. Do you understand? The smaller time frame is about to align with the bigger time frame. So this is where we enter for short position and take profit. We can target the next swing low, which is around there. Take profit to the next swing low. You can go over to the bigger time frame and target your swing low. Let me put this right here. This is the next swing low. This right here is your swing low. So we enter the short position. Let's reflect this to this point also. So take profit to the next swing low. So we just reflected this. Don't get confused. This is the smaller time frame and this is the bigger time frame. So it's the same thing. So this is where we wait for the market to go straight to our take profit, because the market is really going down from the bigger time frame. How do we know the market is going down? Because the market are making lower low, lower high, lower low, lower high, lower low, now lower high. So we're expecting the market to continue going down, giving us a lower low. So what do we expect? We're expecting these markets to go down straight to our take profits. This is your new lower high and this is your new lower low. The trend is going down, you just follow the trend and you got rewarded for following the trend. So don't get confused. This is the smaller time frame and this is the bigger time frame. So the key point here is that you should know when to enter so you don't enter too early. So I gave you example. If you had entered from this point, you see that the market will just start going up, and you might be wondering, why is the market going up when we're in a downtrend? Because the market is just making a retracement and you didn't wait. You have to be patient. It's all about patience. You have to be patient, wait for the market to retrace to the upside, wait for a market shift in the smaller time frame. You can wait for another retracement in the smaller time frame, or maybe not, and then you enter your short position. This is how we cut this profit to the downside. So this is for the downtrend. Also, in the bigger time frame, the market don't just keep going down forever or keep going up forever. There's going to be a point where the market start going down, and when that happens, we see a market shift. So this is your market shift. So we also get market shift in the bigger time frame. So the market don't just keep going up because it's the bigger time frame is going to keep going up. No, when the market wants to reverse in the bigger time frame, we'll see the market shift. So you should take note of this too. So now let's go to the main chart where I'll be showing you a few examples. Now this is Euro USD and we are in the 1 hour time frame. Take a look at this 1 hour time frame, Euro USD. So this 1 hour time frame is a bigger time frame. So this is where we watch where the markets are going. And right now the market is uptrend. How do we know the market is uptrend? Because the market is making higher high, higher low, higher high, higher low, higher high, higher low to the upside. So let's go over to the 15 minutes time frame. Let's see what the 15 minutes time frame is saying. So now this is our 15 minutes time frame. So the market is going down, the market is still going down. So we can't just buy from here because we don't know how down the market is going to go. So let's see how this goes. Remember, all we are waiting for here is a market shift. So as you can see, the market is still going down. I think the market is consolidating right now. Like it's consolidating. It's no more going up. It's not going down. Just consolidating. This is a consolidation, as you can see. This right here, they're all consolidations. We haven't seen our market shift yet. This is where we have to be patient. As a trader, you really have to be patient because this game is all about patience. Now we've seen our market shift. How do we know this is our market shift? The market broke this high. Let me show you. Take a look at this. Let's mark this out. The market broke this high, giving us a market shift. This is our market shift right here. So now we have to wait for market to retrace down to this area at least before we can enter for a long position. This same area where the market shift was. Okay, our stop loss below the recent low. This is the recent low, and I'll take profit to the next swing high. This is our swing high. So this is where we raise our take profit to, because that may be the next exit point of the market. So this is what we're expecting actually, the market to come down and then go straight to our take profit. And like I told you before, why are we buying? Because the market is in an uptrend in the bigger time frame. Go to the bigger time frame, you see that we are currently in an uptrend. And now we have come over to the smaller time frame to wait for our market shift. Now we've seen a market shift, we'll wait for a retracement to our point of interest. This means the point where we are okay to take a position. So now we have to wait. As you can see, the market just gave us a retracement and now we are currently in massive profits. So let's look how it plays out. As you can see right now, we're currently in profits. And now we're waiting for the market to smash our take profit. Just a few pips for the market to smash our take profits. The market is still consolidating. Just a few pips to our take profits. The market is really coming down aggressively. But we don't have to be afraid because we are only doing what the bigger time frame is showing us. We are following the bigger time frame, so we're more often a safe side than the danger side. As you can see right now, the market hit our take profits. Take a look at this trade. This trade is really a nice trade. So how did we catch this move to the upside? All we have to do was wait for a retracement to the downside, which we waited, and we waited for our market shift. So this was our market shift. This means the market is about to go up. And then we waited for retracement. The market gave us a retracement. This is when we entered the market. And then, although the market tried to play some little tricks with us by almost hitting our TP and then reversing to our stop loss, but most traders will want to exit this trade from this point. But if you really know what you are doing, you don't need to be afraid because we're only doing what the bigger time frame is showing us. And when we are working with the bigger time frame, if the bigger time frame says uptrend and we are buying, this means we are working with the bigger time frame. And when we're working with the bigger time frame, we have nothing to fear because we're more in the winning side. So this is how we caught this move to the upside, and this is a really nice profit. So let's go over to take more examples. Let's go to gold. So this is gold. XAU USD is gold. You can see this right here. XAU USD, that's gold. And we are in the 1 hour time frame. Take a look at this 1 hour time frame. So let's find another example here on gold. And as you can see, we're currently in a downtrend. The market is going down. How do we know that the market is going down? Because we can see the lower lows and lower highs to the downside. So right now, let's go over to the smaller time frame to find sell opportunities. So as you can see right now, we're in the 5 minutes time frame, and right now it seems like the market is retracing to the upside. So this is where we have to wait for the market to finish retracing, and then we can find our market shifts before we can enter the market. Right now the market is still taking time. It's all about patience. You have to wait because you don't have to rush the market. This is something you must know how to do. Patience. You have to exercise patience and wait for the market to come to you. Don't rush the market. Wait for the market to come to you. So right now we're still waiting because the market is retracing to the upside. Remember, all we are looking out for is market shifts. So let's wait a little longer. So right now we're still waiting. The market is still on the move. The market has not given us a market shift. You can see from here the market is making higher high, higher low, higher high, higher low, higher high, higher low. Now it seems like the market is consolidating from this point. So let's exercise patience and let's see what the markets are really doing. So right now the market is still consolidating around this area. The market is no more trying to move higher, but the market is getting weak, so it could go lower. So let's see what happens next. Okay, right now we have our market shift. The market broke this low. As a support and resistance trader, we'll say the market broke our resistance area. Since we're trading market structure, we'll say the market has given us a market shift. Let's take a look at this. The market is going up, and all of a sudden, the market broke to the downside. And taking a good look at this, this is a head and shoulder pattern. If you don't know about pattern, I'll recommend you watch this video right here where I explain about patterns. So this is clearly a head and shoulder pattern. And when you see a head and shoulder pattern, this is a reversal pattern. This means the market is about to go to the downside. When we see a head and shoulder in the market, this means the market is about to change direction. You can see this is the left shoulder, this is the head, and this is the right shoulder. So the market just broke the neckline of the head and shoulders. This is the neckline. The market broke the neckline of the head and shoulder pattern. So if you know about patterns, you understand what I'm trying to say. So according to market structure, the market has given us a market shift. You can see that right here. Market is going up and all of a sudden the market broke to the downside. So from this point, what do we do next? This is where we wait for a retracement to the upside. We'll have to wait for a retracement to at least this area. This is where we have to enter our sell position. So let's wait for a retracement and see if we'll get one. This is confirmation enough that the market has given us all we wanted. We've gone to the bigger time frame, we've seen that the market is going down in a downtrend. Now we've come to the smaller time frame and we are waiting for our market shift, which will go our market shift right here. This is our market shift right here. So the market has given us a market shift. Now the market has retraced to the upside. So now we can say, okay, let's enter a short position. As you can see, this is the recent high around here, this high here. So raise our stop loss above the recent high. And this is a 20 pip stop loss. So this is where we can go over to the bigger time frame where we'll find our swing low. So 1 hour time frame. Now we're in the 1 hour time frame. We can place our take profit down all the way down here. So let's mark this out. So take profit down to this point. So now let's go over to the smaller time frame. So right now we're back to the 15 minutes time frame. We just entered a short position on gold and we are certain for sure that this market is about to go down. So let's see what the market does next after we've entered a short position. Okay, right now we're currently in profits. Okay, it seems like the market is playing with our feelings. Sometimes this happens. The market may want to play with you a little and trying to go to your stop loss, but if you know what you're doing, you don't have to be afraid. All you have to do is just stay focused. So right now it seems like the market is still consolidating around this area. Let's go over to the 15 minutes time frame so we get a clean view. Now the market is pushing to the downside. You can see this. As you can see, the market eventually smashed our take profit. So how did we manage to catch this whole move? This is because we've seen that the bigger time frame is in a downtrend. Take a look at this. The bigger time frame is in a downtrend. The bigger time frame is making lower low, lower high, lower low, lower high. So this is where we went over to the smaller time frame to find our market shift. We went over to the smaller time frame, which is the 5 minutes, and eventually we had our market shifts. Take a look at this right here, market shifts. So when we found this market shift, we waited for retracement to the upside, which is this retracement to the upside, and this is where we entered a short position. And the market, although consolidated a little, but eventually the market goes down straight to our take profit. So we caught this whole move just because we followed the trend. Do you understand? Just because we followed the trend, this is why we made this profit to the downside. So if you remembered from this point, we saw a head and shoulder pattern. And what do head and shoulder pattern represent? It represents a reversal pattern. When we see a head and shoulder in the market, this means the market is about to reverse. As you can see, this is the left shoulder, this is the head, and this is the right shoulder. So we waited for the market to break the neckline of the head and shoulder before we enter. So you should also take note of this. Not only the market shift is our reversal pattern. This means the market is about to go down. Yes, when we see a market shift, it means the market is about to go down. But we should also expect other reversal pattern like this head and shoulders or double top. So what I'm trying to say is that we should expect reversal patterns too. We should not focus all our mind on waiting for market shifts. We should also expect reversal pattern such as the head and shoulders, the double top or rising wedge. We should also expect these patterns too because they are also reversal pattern. So this is how we caught this move to the downside because we identified our pattern. We saw a market shift. So this two things are confirmation enough that the market is about to go down, and that is how we cut this whole profit to the downside. So that's all for this video, and if you don't understand anything, I want you to understand this. Anytime we're in an uptrend, all you should think is buy, and anytime we're in a downtrend, all you should think is sell, because this bigger time frame controls the smaller time frame. So the bigger time frame tells us what the markets are doing, and we'll go over to the smaller time frame to take our positions. We can't take our positions in the bigger time frame because those candles are very big. So the smaller time frame is where we take our position, is where we enter the market. That's after we've seen a market shift. Market shift is like a break of structure to the opposite side, but it's not called a break of structure. It's called a market shift. And like I told you before, you should also expect reversal patterns. These reversal patterns consist of the head and shoulder. This is the head and shoulder. This is the double top. This is the inverse head and shoulder, and this is the double bottom. So these reversal patterns are also what we should look out for in the market. So that's all for this video, and if you don't understand anything, you can ask questions on the comment section and I will try as much as possible to respond to your question. So don't forget to like and subscribe, and I'll see you in the next video. Peace out.